Greetings of the day to all the learners of Dr. B.R. Ambedkar Open University, Hyderabad. Today we shall talk about classification of insurance as a part of your course Principles and Practice of Insurance. Let us have a brief understanding of what is meant by an insurance contract. An insurance contract is one in which one party, who is called as the insurer, which is the insurance company, undertakes to protect an insured, who is the policy holder, against all kinds of risks which may come on account of happening of a future uncertain event. If there is any future uncertain event which adversely affects the policy holder, the contract says that the insurance company shall compensate the policy holder for all the damages or the losses which are suffered on account of the future uncertain event which will adversely affect the policy holder. This basically is an understanding of an insurance contract which we have already had in our previous lessons. Keeping this background in mind, let us talk about how many types of insurance contracts are there. There are different types of insurance contracts. We basically classify them into two categories. One is called as life insurance and one is non-life or general insurance. Under life insurance, you've got insurance policies which are issued on the life of a person, meaning that if something happens to the person, which is death or any other accidents which may happen on account of which there could be death of an individual, then the insurance policy pays to the nominee or to beneficiaries of that particular insurance policy holder. So, life insurance is of various types. There are around 8 types of life insurance policies. Under non-life, which is also called as general insurance, there are insurance policies which are issued for medical benefits of an individual called as health insurance, insurances which are given to safeguard against all kinds of risks due to travel, which is called travel insurance, insurances which are given for accidents or any damages which may be suffered to motors or vehicles, which are called as motor insurance, insurances which may be there on buildings, property, land, plant, machinery, which is called as your property insurance, insurance for goods or any kind of cargo which is there, or shipment which is there in transit on a ship. So, you have marine insurance, and then fire insurance, basically to safeguard against all kinds of damages which may come on account of outbreak of a fire. These are all the categories of different types of general insurances which are there. So, in today's lesson we will talk about these different categories in detail. First, let us begin with the general insurance categories, under which you have fire insurance. Fire insurance pays or compensates for the damages which may be caused to the property or the goods of an individual on account of fire. If there is an outbreak of fire, the insurance company covers replacement, reconstruction, repair expenses of the insured property, even as well as the surrounding structures. If there is an outbreak of fire on account of which the property is damaged, then the insurance company promises to pay the policy holder for all the replacement, reconstruction and repair expenses that may be incurred for the insured property which was being damaged, as well as the surrounding structures which are there. Under this fire insurance, the items which are included are losses or damages which may be caused to fire of buildings, plant, machinery, equipments, any accessories which may be there, furniture which could be there or furnishings which could be there inside a building, electrical fittings which are there in a building, goods or raw material or semi-finished goods or finished goods which may be there in a godown, that is a warehouse, or it is also there for all kinds of pipelines which may be there inside and outside the building. So, the items which are included in the fire insurance are all these categories, not only the entire structure of a building, but plant, equipment, accessories, raw material, goods, finished goods which may be inside the factory building, pipelines which will be there, furniture, electrical fittings, all these items which may be damaged on account of an outbreak of fire, all of them are all insured under the fire insurance policy. These are all the items which are covered. Now, when a person wants to take a fire insurance policy, there are different types of fire insurance policies. So, you may have to choose from which among these types do you want to take. The first one under the types of fire insurance is the valued policy. Valued policy is one where the insurer is first assessing the value of the property, then undertaking to compensate you for the value in case of any loss or damage, which means that the insurance company is predetermining the value of the property. So, when the insurance contract is entered into, they assess the value of the property and then they enter into the contract. For example, if I own a building in Banjara Hills and then I want to get it insured against any losses due to fire, then the insurance company will assess the value of that property and then enter into a contract. Such a contract where the value of insurance is determined at the time of entering into a contract is called as a valued policy. This is the first type of fire insurance policy. The second one is called valuable policy. Valuable policy is one where the value of the insured property is determined at the time of a loss or a claim, depending upon whatever is the market value of the property at the time of damage. Probably I must have purchased an insurance policy 5 years back, but until 5 years there is no fire outbreak. After the 5th year, probably in the 6th year, if the damage happens, then in the 6th year, whatever would be the value of the property in that year, that will be the basis for me to pay the insurance compensation. This is called as a valuable policy, where the value of the policy is determined at the time of the loss or whenever the event happens and not predetermined. The one which is predetermined is called as a valued policy, whereas valuable policy is one which is determined when the loss or a claim actually happens. Whatever is the market value at that time, then that is your valuable policy. Then the third category is specific policy. Specific policy is one where the insurance company is compensating you for an amount which is less than the real value of the property. If the property is worth 10 crores, the insurance company may say that they will compensate to the extent of only 9 crores. So, remaining 1 crore would be a loss which would be suffered by you. Though the value of the property is 10 crore, they may not give a policy to the extent of the value of the property, but anything less than that. So, when the insurance cover is a specific amount which is less than the real value of the property, it is called as a specific policy, because the insurance company here doesn't take to compensate 100% of the property value. They undertake to compensate less than the whatever is the value of the property. This is called as a specific policy. Then you have the policy which is called as an average policy. In an average policy, what happens is that the insurance company and the insured, both of them have a pre-decided proportion for sharing the losses. The insurance company may say that in the event of a loss, they will share only to the extent of 60%. Remaining 40% should be borne by the insured only. So, insurance company is bearing the loss to the extent of 60%. Remaining 40% will be borne by the policy holder. This arrangement of a policy where you have a pre-decided rate or a proportion to be followed for sharing the damages, this is called as an average policy. This is also one type. So, you have valued policy, predetermined, valuable policy, determined at the time of the loss, specific policy where the amount is less than the real value of the property, an average policy where you have a predetermined share of both the company and the property holder for sharing the losses which are there. Then fifth category is your floating policy. A floating policy is one where a single policy will cover 2 or more properties of the insured which may be there at different locations. A particular individual may be owning different properties at different locations. So, therefore, instead of taking separate policies for all such properties, you can take one single policy, pay a single premium, which will provide for him convenience against buying multiple policies. So, you have one policy which is covering all your properties against fire losses. These properties may be located at different locations. This is called as a floating policy. Then you have a policy which is called as adjustable policy. Adjustable policy is one where insurance amount and premium both are calculated on the existing value of the stock initially, and later it gets adjusted as and when the value of the stock keeps changing. So the premium keeps changing on a pro rata basis. As and when changes in the value of the property happens, the premium value also keeps changing. That's how the word adjustable policy comes into picture there. Then you have a policy which is called as declaration policy. Declaration policy is one where the insurance policy is taken for maximum value of the stock, and company regularly declares what kind of changes happen in the value of that particular stock. You call that as a declaration policy. Then you have a policy which is called comprehensive. See, basically fire insurance covers risks or losses only against fire, but a comprehensive policy is one where insurance cover is given not only for loss by fire but also theft, war, riot, strike, or any kind of disturbances on account of which the property could be damaged, where the risks are very high. Then a comprehensive policy will offer all kinds of security against all these risks also, war, riot, strike, where the chances of a fire outbreak is more on account of all these situations. Then also you have a comprehensive policy which covers all of these. So under your general insurance, this is the first category of policy that you have, which is your fire insurance. Second type of general insurance is your marine insurance. This insurance contract is a contract of assurance where you are assuring that the goods which are sent from a country of origin, say for example India, to a land of destination, say for example Canada, America, Indonesia, Gulf. So these are all the places where the goods which are coming from India have to go. So from a country of origin to the country of destination, when the goods are moving through seaways, there are a lot of damages which can happen on account of perils of sea, damages to the ship, cargo, the terminals which are there. So therefore you need to have insurance for your goods which are being shipped when they reach the final destination. So such a contract where you have assurance that the goods dispatched from the country of origin to the country of destination are insured, you call it as marine insurance. In marine insurance also you have various categories which are there. The first one is called as a freight insurance. Freight is basically the kind of charges which are levied for transportation. So when you have charges which are levied for transporting goods through seaways, that is called as freight. So in freight insurance, if these goods are damaged in transit, then you have to receive back your freight. That goes as a loss for you. So insurance company will compensate for you for the loss of that freight. So whatever are the transportation charges which are there. Then you have insurance which is called liability insurance, where you talk about marine liability as a compensation being provided for any liability which may be incurred if a ship crashes or if a ship collides. So when you have movement of a ship on the sea route, in case the ship crashes or it collides with any other structure which is there on the sea, then liability insurances are being paid as a part of your marine liability. Then you have insurance which is basically for the goods which are being transited, which is called hull insurance, covers the hull and the torso of the transportation vehicle. So whatever are the transportation charges which are there, all kinds of damages and accidents which may happen, hull insurance basically covers it. Then you have a cargo insurance, the actual goods which are getting transited. For that also you have insurance policy which is marine cargo policy, where you talk about insurance of goods which are dispatched from the country of origin to the country of destination. So you have cargo insurance which is there. Now when you have to make a choice of all these insurance policies, a particular insurance company may offer to you different varieties of policies which can be there. So if I want to take a liability insurance or a hull insurance or a freight insurance, then what kind of policies are available to me? One is called as a floating policy, where if you have, it's an open policy or a blanket policy. Instead of taking a separate insurance policy for every shipment, you take one insurance policy for all your shipments. So it is called as a floating policy. Say for example, I am an exporter. I am exporting cargo, 1 which goes to country A, cargo 2 which goes to country B, cargo 3 which may go to country X, then instead of taking separate policies for these many cargoes going to different countries, I will take one policy for all the shipments together. That is called as a floating policy. Then you have a second policy which is called voyage policy. Voyage policy is a specific policy which is only for a particular consignment. It is only for a single lot. Only for one lot of consignment that you may be sending, the exporter will have to purchase insurance cover every time the shipment is sent. So, for every voyage, for every travel that happens through the seaways, voyage policy has to be taken. Then you have a policy which is called as a time policy, where usually it is issued for a period of 1 year. Over a period of 1 year, how many ever voyages may be done by the exporter, then all those will be covered under this particular time policy which will be there. Then you have a policy which is called mixed and voyage, where you have voyage and time both put together is your mixed policy which will be there. So, over a period of 1 year, how many number of times an exporter is sending consignment to another country, all those consignments within 1 year will be covered under your mixed policy. Then you have a policy which is called as named policy, in which the name of the ship which is actually carrying your goods is mentioned when that policy is being issued. So, that is called as a named policy. All these vehicles, the ships have got certain names to them. So, the entire ship will be named in that particular policy. So, stating the policy which is issued in the name of the ship is called as the named policy. Then you have a policy which is called port risk policy. Now, this type of a policy is not for when the goods are in transit, but this is basically for those goods which are stationed at the port, because there are also chances of all kinds of risks and damages which may happen to the goods when they are stationed at the port also. So, they also need to be insured. So, you have a port risk policy which will ensure safety of the goods when they are stationed at the port, in the seaport when the goods are being kept. If any damage happens to them, because they are not yet loaded onto the ship. So, therefore, if any risks or damages are there at that point of time, then port risk policy will cover all of those damages. Then you have damages, then you have a policy where you talk about these owners of ships, if they have multiple ships with them, if they take a policy which is covering insurance for all the ships. If I have ship 1 which is a very big vehicle, if I have another 2-3 ships which are smaller vehicles, one big ship which I am using for a far distance, smaller ships which I am using for a nearby country connecting through the sea route, then for all these small big ships which I have, I may take one policy which is covering all of them. This policy will be called as a fleet policy. Fleet is all vehicles put together. So, all ships which I have as an owner, as a company, all these I will put under one policy which will be called as a fleet policy. Or I can take a policy separately for every vehicle, every vessel that I have, every ship that I have, I can take a separate policy which will be called as a single vessel policy. That way I have different types of policies depending upon what type of an insurance I am taking, when the goods are getting shipped, what type of a vehicle do I have, that is ship I have, and how for what period of time am I taking the policy. Based on that you have marine insurance. So, the first part we have discussed fire insurance, the second part marine insurance. Now, coming to the third category under general insurance is motor insurance. Motor insurance is the basic insurance policy which usually all of us take, basically for our cars, for our bikes, or any other vehicle which we may be running on the road. First one under this comes as your car insurance. Personally owned 4-wheeler cars or any 4-wheeler vehicle will be covered under your car insurance policy. 2-wheeler insurance, personally owned 2-wheelers including bikes, scooters are all covered under this plan. Commercial vehicle policy, if you are owning a vehicle which is used for commercial purposes, then you will have a commercial vehicle policy, because the first two are personally owned vehicle, the third one is for vehicles which are used for commercial purposes, transportation, etc. Under this motor insurance, out of these three, you can have different types again. You can go for a third party liability where the insurance company plans to pay liability to the third party which is affected in the accident, so that the policy holder is going hassle free. So, say for example, if I am riding and if my bike may dashes into the bike of another person, then the third party suffering damages, insurance company will pay damages directly to the third party, so that I am free from all kinds of legal hassles which are there. This is called as a third party liability. Then you have a comprehensive coverage, where exclusively covering third party is your third party liability, but in case there are any damages or repairs which are to be done to the policy holder's vehicle also, because accident has happened, naturally damage will be for the third party vehicle also, for your vehicle also. So if the policy covers only third party damages, it's a third party liability. But if the policy covers both third party as well as damages to the holder's vehicle also, policy holder's vehicle also, it is called as a comprehensive cover. This is a better type of insurance, because naturally in an accident both the vehicles are bound to be damaged. Then you have an own damage cover. Sometimes it so happens that insurer suffers several damages on not because of hitting a third party vehicle, but on account of any other accident that may be simply caused while learning to drive, or simply while driving, or you may hit a stone on the road or a pavement or a divider. All these things can happen, because of its own vehicle may be damaged. So you call it as own damage cover. This is also one type of an insurance policy for motor insurance. These are popularly there, but most prominently used nowadays is your health insurance, which is basically covering all kinds of medical expenses which may arise on account of any illness which the policyholder may have, and hospitalization cost of medicines, and doctor's consultation fee. All these things will be covered as a part of your health insurance, which is also called as your medical insurance. In health insurance, you have different categories depending on who is the insured. If the insured is an individual, then you have an individual health insurance plan. You have different companies which are offering nowadays. You have so many private players also who are offering medical insurance. Star Health is one of the most popular private players who are there. Many banks have also come forward to offer medical insurances. So as an individual, you have individual health insurance plan. If you have a plan for the whole family, you want yourself, your spouse, your children, your parents to be covered, then you have a plan which is called as a family floater. So the entire family is covered as a part of that plan. Most of the companies, corporate houses, they take a health insurance plan for the entire group of people. So you call it as a group health cover. So the whole of set of employees will be covered as a part of your group health cover. Then senior citizens who are of the age of 65 and above, for them you have a separate cover which is called as your senior citizen health cover, because they are prone to more kind of illness and critical diseases when compared to other age groups. So you have a different plan which is catering to the needs of illness of senior citizens. Then you have a critical illness health cover. In case people are suffering from any kind of chronic diseases, then you have critical illness health cover which can also be there. Then in case, say for example, if I have taken a medical insurance of 5 lakhs and then I met with an accident and then I got hospitalized, and up to the extent of 4.5 lakhs I have already exhausted in the beginning of the year itself, then what do I do with the medical expenses throughout the year? So then I can go for a top-up policy, where same policy, when the sum assured is exhausted, I can go, it's like a mobile recharge. When your top-up is over, you recharge. So same way, if the policy assured amount has got exhausted, then you can go for a super top-up policy, where it will assure you more than whatever was your initial sum assured which was there. This is a popular type of an insurance policy under your general insurance. So we have fire insurance, marine insurance, travel insurance, health insurance. 3 we have discussed. The 4th one is your travel insurance. Under travel insurance, you have all kinds of cost, losses, expenses which may be associated because of travel. So when people are traveling, you may have range of services like baggage, passport, loss of baggages and passport, flight delays, flight cancellation, medical cover, all these during the flight. So in case you see if there is a flight delay, there could be some kind of a significant loss to the passenger on account of flight delay. So you have a flight delay cover. That is an insurance policy. During travel, if you have lost your baggage or luggage, then the insurance policy will assure you any monetary assistance on account of baggage losses and all. Then reclaim lost travel documents. If your visa, passport, any other essential documents during an international trip have to be insured, then you have reclaiming lost travel documents policy also. Then you have trip cancellation. Usually what happens, there could be a sudden death in the family, a medical emergency in the family, on account of which you may have to cancel your trip. So then you will have your trip cancellation coverage also, which can be there. So these are all types of your travel insurance. Then your property insurance, where you talk about insuring all your immovable property like your home, shops, offices, buildings. All these are your property insurance. These are all a part of your general insurance or non-life insurance. Now coming to life insurance. Life insurance policies basically are giving financial freedom to the family members of a policy holder. In case of a death or an event of a death of a policy holder, then family members or the nominees of that particular policy holder will be paid a financial compensation. No doubt nobody can replace the person because people are indispensable, but all kinds of financial damages that may be suffered because of a loss of a life, that to some extent insurance company tries to cover that. Under this you have term life. Term life policy is basically during a particular term, like it may go from 1 year up to 30 years. So policy holder will pay premium from 1 to 30 years, and after that upon maturity the amount will be paid. Then you also have something called as whole life insurance, where the premiums will be paid throughout the life till the person dies. Then the benefit will go to the nominee after the death of a person. Then you also have something called as an endowment plan, which is like a saving plan. So up till a particular maturity, like 15 years, I will keep paying premium. Then after that I will get the sum assured. After the expiry of the maturity period, I will get the sum assured, and then the premium policy will be paid up till the maturity. This is your endowment plan. Then most of the parents also take children policy, so that when the children attain various stages in life like higher education, marriage, then children policy will come to their rescue. Then you also have annuity plans, which are basically taking care of the old age, where you talk about pension being paid to individuals who must have been paying premiums throughout their life. Then you have money back plan, where you are paying premium policies for up to certain specified intervals, and then survival benefits will come after the termination of the policy. Then group insurances are also there. Most of the companies take group insurance, where you talk about contributory, employer, employee, both of them contribute, or you have non-contributory, where only the employer will contribute, employee doesn't contribute. This is also one type. Then you have insurance policy which is unit linked. Unit linked is basically serving the purpose of both saving, protection as well as investment. People want to take insurance not only as a safety measure but also as an investment measure, where they want their money to multiply. So in that case they go for ULIP. ULIP is nothing but unit linked insurance plan. So here we have all these as types of insurance policy. So in today's lesson we have covered classification of insurance, where we spoke about what is an insurance contract. We spoke about different types of insurance under life and non-life. Under non-life we have basic categories of health, travel, motor, fire, marine, and under life you have term, whole life, endowment plan, money back plan, annuity plans, children insurance plan. All of these plans basically are helping policy holders to claim all losses or damages which may be coming on account of any future uncertain event where insurance company is compensating the policy holder. Basically, if you see the insurance scenario in India, the major player in insurance market was LIC and GIC, but today you have got, on account of privatization, many players also which have come into the market, and all of them are helping to grow the insurance company. Government of India have also opened insurance sector to global players. So today you also have foreign companies which are offering insurance policy because they have raised the FDI limit of insurance companies. So now you have insurance investments which are coming to the extent of 49%. So you have global players, you have domestic players, you have private players, you have the government bodies like LIC which are engaged in the business of insurance. So insurance as such, all these are the classifications which are there. So in today's session we have spoken about what is insurance, what are the different types of general insurances and the respective policies there, and the different types of life insurance and the respective policies which are there in the life insurances. Thank you so much.